Okay, hello, welcome everybody to this webinar series from FSinsight. My name is Jeroen Derwall. I'm affiliated with Tilburg University. Today I'm also accompanied by Lloyd Kurtz. He is the Chief Investment Officer of Nelson Capital Management. And we decided to organize this webinar also in response to a number of questions that we have been receiving repeatedly when it comes to the value of ESG factors and the value of sustainable investments in general. So what we're going to do is we're going to respond to some of the questions which were also part of the announcement that we made. And at the same time, we're also giving you the opportunity to ask questions yourself. If you look on your screen, you can see on the bottom right a little balloon. And in that balloon, you can ask your own questions. And these questions we will collect. And at some point during the webinar, if time permits us, we will try to answer your questions in greater length. OK, so let's simply start. The first question that we receive a lot is a very simple question. It is related to the developments that we have seen in the last couple of years that active money managers or mainstream institutions in general are trying to use information about the sustainability practices of companies to deliver exceptional returns. So in other words, the question is whether ESG factors help them to produce alpha. And there are quite some people who are wondering whether this is a sustainable way to implement responsible investments in the long term or sustainable investments. So one of the criticisms that we hear lately is that this idea about using ESG information to beat the market or create alpha seems to be inconsistent with the idea of efficient capital markets. The idea that at some point markets will respond rapidly to new information, and therefore at some point this type of information, including environmental, social and governance type of information, cannot be used to create exceptional returns in the long run. So, well, we've been doing quite some research in this area, so it would be a good idea to respond based on that research first. So the idea that investors can use information about the sustainability practices of companies leans heavily on the idea that for some reason the capital market overlooks this type of information. Well, one way to justify that idea is to see where does the value of ESG actually come from. One way that companies can create value through responsible business practices, in my view, I don't know how you look at it, Lloyd, is by creating loyalty. So for example, when companies have strong relationships with their employees, or when they develop products that are environmentally conscious, they might create loyal customers. Now this type of value, in my opinion, can be regarded as intangible value. And I think history has suggested that capital markets might have been reluctant to properly value that type of information. How do you look at that?
No, I think that's right. And conventional investment factors have worked very well for a long time and maybe are working less well the last 10 years. So active managers through history have tried to beat the market in various ways. One of the few ways that's worked is just buying cheap stocks. Statistically, not that difficult to do the math. And I think markets now are becoming more efficient with respect to the valuation factor. If you look at fundamental analysis, at least in the States and also to a degree in Europe, fundamental analysis is less effective than it used to be. So it's natural to look toward intangible sources of value, things that are a little harder to get at, like your work in sustainability. We've seen that sometimes the ESG factors relate to fundamental effects, and the market may not be perfect in its assimilation of that information. It may take time for the market to figure out that sustainability practices improve the asset efficiency of the firm and the earning power of the firm.
Yeah, and I guess one could also relate that reasoning to earlier evidence that has suggested that also simple investments in R&D, companies' investments in R&D, might not have been picked up properly by the capital market. Now, however, of course, we also know that attention for environmental, social and governance issues has risen dramatically in the last couple of years, fueled by numerous events, fueled by greater academic attention for this topic. And of course, you could argue that at some point, markets might learn more and more about what ESG can mean for the valuation of companies. And I think this is where the worry comes from, that ultimately using this type of information for the purpose of beating the market as an investor might be not feasible for the long run. And in fact, my personal experience, also based on some literature that I've been looking at, suggests that this effect of learning seems to take place. So, for example, there has been a study conducted by several scholars from amongst other schools, Harvard, I think. They seem to provide evidence that capital markets are becoming more attentive to the corporate governance structures of companies, and that studies that have shown that investment strategies that make use of corporate governance information and which appear to have delivered alpha in the past, these strategies don't seem to work anymore these days when it comes to delivering alpha. And it also appears that when you look at the errors made by analysts, these forecast errors seem to be less explained these days by corporate governance information than used to be the case before. I also know from one of my own types of research that this evidence also carries over to sustainability information. So, for example, one of the rating agencies that you are very familiar with, KLD, they provide a rating that has been very popular in academic research and which has been linked to superior investment returns in the past. Also, this type of information does not seem to be helpful in generating abnormal returns or helping investors beat the market the way it used to, according to several studies. One of our studies suggests that also this type of information is picked up more easily by investors than before. So yeah, this seems to be consistent with the idea that at some point markets learn about the value of ESG information. How do you think about this?
No, I think you're right. I think it depends on what kind of an investor we're talking about. I think that becomes very important. An alpha-driven investor who's trying to use ESG factors to beat the market needs to understand that this underlying logic is the same logic that pertains to all of these variables. The effects are likely to be temporary. There might be a multi-year adjustment phase, but ultimately the market is going to figure this out. If the market is mispricing things, there are a lot of intelligent people putting a lot of money to work, and ultimately prices are going to adjust. I think we've seen that to some degree in sustainability, where there are purpose-built strategies to exploit inefficiencies around sustainability. I think we'll probably see it in employee relations, where there's a purpose-built strategy designed to exploit that that's received a lot of publicity. What I think is provocative, though, is that your study, the study by Alex Edmonds on the 100 best companies to work for in America, showed that such factors do exist. It's possible that there might be 10 more. And so really the race now is on among the active managers to try and identify what other intangible value factors are there? How can I be early? How can I get involved with companies that express those factors and use that to get a performance advantage? Mm-hmm. But I think managers who are pursuing that type of an approach are going to see their strategies diverging from traditional values-based investing. I think ultimately you have to pick a mission. Am I trying to beat the market with intangible information, or am I trying to maintain a level of standardization or a level of consistency with a particular set of values or ethics? Mm-hmm. For a long time, investors tried to have it both ways, but I think that the two fields or the two missions are diverging strongly enough that now investors are beginning to have to choose.
Okay. What do you think personally about the role of rating agencies, and can they help out in helping both types of investors?
Yeah, I was shocked both at the original literature that showed that the KLD ratings really did have information that was relevant for returns. I didn't fully expect that because I believe the KLD database, when I was originally working on it a long time ago, was primarily values driven. It wasn't intended to be an alpha product, and we were a little surprised when we saw that some of the things we were tracking did have alpha properties. What's interesting to me now is that you also have a decay. We found the effects, or academics found the effects more than money managers did, and then the effects seem to have dropped off through time. So the market has adjusted.
Yeah, so perhaps we can also conclude that rating agencies can still add value, of course, but we have to acknowledge that if active management relies on ratings, then these ratings need to be at least up-to-date, updated frequently, incorporating new types of information that captures new sources of intangible value that might not yet be properly looked at, because existing information at some point will be incorporated, of course.
I think that's exactly right. And the ratings themselves are imperfect. We are still in the early stages of learning how to do this. Intangible information is intangible for a reason. It's hard to standardize. It's hard to quantify. It's hard to express. So that we are seeing a wave of innovation. We're seeing new agencies coming forward with different approaches, different standards. especially when we move from a national market to a global market. We have to move from behavior-based ratings to policy-based ratings because the level of global disclosure is not as good as we might have in a particular national market. So the goal, I think, is to get better ratings that capture fundamentally relevant information but are also informing the value side of the equation.
Okay, yeah. A related question that we received was also the following. Based on all the discussions that we've heard about so far, would perhaps the idea of shareholder activism or engagement be a better alternative to be a responsible or sustainable investor compared to a screening-based approach? What is your opinion on this?
I think if you want to see active money managers do engagement, and I'm talking really about mainstream money managers, the clients are going to have to make them do it. And the reason for that is the relative cost of engagement strategies versus the alternative, which is exit. If a company is really doing something that's dysfunctional and harmful for returns, and there doesn't seem to be much likelihood of change, exit in a low transaction cost environment, exit is a very appealing choice. You can simply sell the stock. We call this, in the States, we call it the Wall Street rule. If you don't like the CEO, sell the stock. If you don't like the manager, sell the stock. So we need the larger clients, the opinion leaders and institutional investors who show leadership, to use engagement or to encourage us to use engagement to think more long-term and try and prompt change. Because change requires investment, it requires specialized people and specialized effort and research. A lot of money managers don't want to bother with that. I do think it's a differentiator for some of the purpose-built social investment firms that they've developed these skills over a long time. There are strong firms in Europe and in the US that really use engagement as part of their overall value proposition.
Yeah, so in principle, I also believe that engagement has one advantage in the sense that you're acting before actually the actual ESG development takes place. So you're kind of one step ahead of what would be typically called a screening-based investor, right? So you're kind of not acting on a change in sustainability programs at a company. You're actually already a shareholder when the company implements the program. So if there is a value effect, a shareholder wealth effect resulting from such a sustainability program, then you're actually reaping the benefits. If you are a screening-based investor, yeah, then the question of whether you're reaping the benefits depends also again on the question whether the market is already valuing that properly. So in that sense, I also believe that with engagement, you might be one step ahead of the rest. Of course, also, there are quite some problems, and you also implicitly highlighted some of that. For example, the fact that shareholders are not all alike. So also when it comes to engagement, there might be conflicts of interest. Some shareholders from the US might have different beliefs about the role of unions than, for example, shareholders in Europe. So I'm a bit in doubt about how these conflicts can be solved, to be honest. However, when we look at the evidence on engagement, the recent evidence also that you have evaluated as a judge of the Moskowitz Prize, this evidence suggests that private engagements might actually pay off.
Yeah, I think we have a couple good studies. There's so many investors, it's hard to study this systematically because to do a good study of engagement, you have to zoom in on the activities of one investor because we don't have a public database of engagement records. But the Dimson study showed that even though 80% of the engagements failed for this one investor, 20% succeeded, and the 20% that succeeded, mainly around sustainability and governance criteria, did lead to positive market reactions. And that echoes a study on governance Brad Barber did a few years ago. Brad Barber of Cal Davis studied the CalPERS corporate governance program, and he found that when they targeted a company, generally there was a positive reaction. It's variable and it's a small sample, but there does seem to be a benefit, a financial benefit to certain engagement activity. The firms that have been studied so far, CalPERS and the one in the Dimson study, which hasn't been identified, are, as near as we can tell, very sophisticated engagement practitioners. So I think there's also a question of whether the benefits of engagement would be positive for if it were more widely adopted by other managers.
Yeah. And of course also the question is, does the engagement not only lead to better performance, but actually have more impact?
That's right.
Yeah. Okay, let's move on to a third question, and after that we move on to some questions from the crowd. The third question that we received was, does better environmental and social and governance lead to a lower cost of capital? Well, I can say something about that for sure. There have been quite some studies, especially recent studies, suggesting that companies that have a better environmental track record or have better relationships with their employees and have better corporate governance structures, they do have a lower cost of equity capital. Some other studies also suggest that these firms with better ESG also have a lower cost of debt. What is not entirely clear to me at this point is the mechanism behind this, and also the question of causality plays a big role. So several of these studies also highlight the possibility that the causality runs backwards. That, for example, firms which have a lower cost of capital have more flexibility in getting better environmental and social, achieving better environmental and social performance. However, from a theoretical standpoint, it is true, also related to the first question, that rising attention in the capital market for environmental and social issues may cause companies that perform better on environmental and social and governance issues to be more liked by the capital market. And as a result, they can enjoy a lower cost of capital. I don't know how you feel about this, Lloyd.
Yeah, I think there's a bit of a contradiction. There was an article in one of the financial newspapers a couple of weeks ago where an analyst expressed the opinion that ESG strategies consistently outperform and that ESG reduces the cost of capital for the company. It's hard to make that add up. You're talking about two sides of the same trade and both sides can't win.
Yeah.
So these new studies are disruptive. They really are changing our understanding of how ESG investing is going to work, especially for alpha-seeking practitioners. I think there are a couple of elements. First of all, I think what's been observed so far is perfectly consistent with what theory would predict. This is information that was new. Markets gradually absorbed it. Asset prices adjusted. During that adjustment phase, owning the better assets from an ESG perspective will lead to superior returns. But once the adjustment phase is complete, then those investors are faced with the possibility of a lower rate of return. The question is, will they receive some kind of compensation? Will they get some benefit from risk? On the fixed income side, we have the Bauer-Hahn study showing that bond investors are accepting lower yields. Will that be compensated with a lower default experience? It'll take a long time before we know for sure. So these are open questions, and I think the initial finding is disruptive, but there's still a lot more to learn before we can talk about how it's going to work in investment practice. The other point I'd make around this is that markets that are less efficient, where the ESG information hasn't been well developed, such as emerging markets, are probably good candidates for practitioners or investment strategies that are seeking to capture alpha, because if these effects are as powerful as they appear to be, they've barely gotten underway in the emerging markets framework.
Yeah, I would agree. I think you also highlight an interesting contradiction, so perhaps we should reiterate it again. There are quite some people who are asking how it is possible that studies document higher returns associated with better ESG in the long run, and some studies document a lower cost of capital associated with better environmental and social and governance practices. Because, well, especially the academics among us, they will equate lower cost of capital with lower returns in the long run. So there seems to be some inconsistency, which is, of course, worthy of future research. However, perhaps we can also kind of reconcile these views, because those studies that have been documenting a lower cost of capital associated with better ESG most probably have gotten that evidence from more recent periods, which is exactly the period during which attention for ESG has risen, and which is also exactly the period for which studies suggest that the positive return effects of ESG have diminished. So perhaps there's some kind of a way to reconcile these things.
Well, what do you think of the idea that ESG is some kind of a signaling mechanism, that maybe what we're really doing is indirectly measuring a quality effect, where a company that can afford to invest in ESG practices and be a leader is sort of signaling to the world, hey, we have a good management team, we have a lot of money, we can make our numbers and do all these extra investments?
Yeah, I think I would agree that it is possible that there might be indirect channels as well, for sure. It could also be the case that perhaps not ESG directly is causing all these effects. It could also be the case that ESG just signals something else or proxies for something that is perhaps much more clearly linked to cost of capital effects or even earnings effects in the long run, for sure. Given the time constraint, I think we still have 10 minutes left. Perhaps it would be a good idea to respond to some of the questions that I now see on the screen. For example, there's a question which goes as follows. If there is a cost of capital effect, will markets convince companies to change their behavior? What do you think, Lloyd?
It's putting out a strong incentive. I think it's an open question whether a money manager can exploit this. This is the competition among money managers, but I don't think it's at all ambiguous. If you're the CEO of a company and markets are going to increase your stock price and reduce your bond yield, you have a strong economic incentive to improve the corporate social responsibility of your firm. That's a great outcome from a societal perspective.
Yeah, yeah. So as soon as the cost of capital effect just becomes large enough, I guess it will be rational for companies to simply reconsider their practices, because probably the cost of reforming to a better or more sustainable company is then probably less than the penalty they face in the capital markets.
And again, I think this is especially true in emerging markets and in markets outside the traditional G20 markets, where a company that is perceived as, say, a Taiwanese company has a lot to gain if it can be perceived as a global company, meeting a global standard. It'll be re-rated from a PE perspective and probably have a better rating in the bond markets as well.
Okay, yeah. Another question which was related to our first discussion point about whether ESG information is losing its competitive edge. There's a very general question. Is ESG information not valuable anymore? I guess perhaps it is very important to stress that the findings about the idea that markets are now learning about ESG, causing active money managers not to benefit from ESG information anymore, actually implies that probably ESG is valued more than it has been in the past by the capital markets. So in some sense, you could argue that ESG actually is very valuable, but also that this value is actually now better seen than before by the capital market. And this has actually wider implications because from a company manager's perspective, of course, it only pays off to invest in projects that are actually valued properly by the market. So perhaps the fact that, or the observation that capital markets appear to be more attentive to ESG practices actually incentivizes companies to do more with ESG and to be more sustainable. Because in the past, there might have been a line of reasoning, something like, the market doesn't see it, so why would we invest in new projects?
And I think the market's hypothesis was a defensible one. The idea was that this is just malinvestment. If you're going to spend money on a sustainability program, isn't that just a straight subtraction from shareholder wealth? But now there's a good book out about the Walmart sustainability program called Force of Nature that describes how once they embarked on this program, they started finding cost savings everywhere. Economies from shipping, less costs of disposing of waste. And the result of that was that they had an economic benefit that significantly exceeded the outlay for the sustainability program. And it fits with the study that you've done. And so I think that the malinvestment argument has probably been addressed. What we don't know today, and where I think the active managers are really energetically trying to find opportunities, is how many other areas are there, like employee relations and sustainability? How many other places can we go where the ESG factors are giving us an inside track to get better returns? And we don't know the answer to that yet.
No. Okay, thank you. A question about shareholder engagement. Shareholder engagement can be very expensive. So how does that affect the use of these strategies, also in comparison to a screenings-based approach?
Yeah, I think most money managers will not do them voluntarily, with the exception of some of the SRI specialist firms. And that's why I think the impetus has to come from the large institutions, the universal owners who have a responsibility for the social and environmental effects of their investment companies. That's why I think you've seen CalPERS in the States and some of the leading European pension funds lead in engagement, because an individual money manager doesn't have much incentive to do it. Yeah.
Do you also think that when you look at the current spectrum of engagers, do you think there is room for other participants? My personal impression is, especially if you look at public shareholder activism in the US, it has been mainly the religious institutions and unions involved in it, and some, as you mentioned, public pension funds. You see hardly any mutual funds so far submitting proposals to be voted on during shareholder meetings. Does it mean that they're probably not doing anything, or do you think that they're probably doing it in the form of private engagement?
I think a lot of them are outsourcing it. Especially in the States, there are services where you can just say, my fiduciary duty is discharged because I've asked an independent service to handle the proxy voting and handle my fiduciary obligations. For me, this is increasingly an unsatisfactory answer. if you are representing the owners, you need to have the full fiduciary responsibility. And if there are governance problems at the company, I think that there is an obligation. And because we have these chains of agents now, we don't own stocks directly much anymore. We own shares in a fund, which owns shares in the stocks. There's a management company that's involved. There is a loss of efficiency. The process loses some of the directness and immediacy that direct ownership would have. So that's something I think we need to work on.
Okay. I think we have two more last questions so far. Perhaps more will enter later. One question is also, do you think, Lloyd, and also addressed to me, do you think that particular ESG factors might still have value?
Yeah, I suspect, particularly in governance, I don't think we understand exactly what's going on yet. I think that's a very robust opportunity for people who want to capture intangible value. Governance is so fundamental, and yet we don't have a globally accepted standard. We don't have globally accepted ratings for governance. The ratings we do have don't behave in a linear fashion in the models we use. So there's a lot we don't understand and we need to explore, because governance is the central relationship of capitalism. It's passive shareholders hiring a management team to safeguard their assets. And so it's an odd thing to not understand well. And as we say, an opportunity for future research.
Yeah, yeah. I personally am actually still intrigued by the value of investing in human capital. So even though we know that there is rising attention for these issues, I think there is some room for detecting, let's say, value that is not properly understood by the capital market or perhaps by even rating agencies. And it has to do, of course, also with the fact that accounting conventions really don't permit you to fully understand how much a company invests in its employees and how that investment translates into better cash flows. Yeah. There are quite some companies, consulting companies, trying to collect data, and they even highlight that knowing how much a company invests in its employees, you cannot pick it up from the balance sheet. Even finding something very elementary as salary expenses is very difficult to find, especially for non-US companies, where also, of course, the reporting standards might be a bit different. I think there's still quite some information that is not easily revealed to the market, not to mention understood by the markets.
I think your point on human capital is well taken, and there are a couple of fascinating aspects to it. One is that there's a strong correlation between human capital and the skills required, the especially R&D intensity of the company. This has made it hard to study. There was a study a few years ago that showed that a lot of corporate social responsibility effects seem to be proxying for R&D intensity. R&D intensity, of course, suggests a more value-added business, pharmaceuticals or semiconductors, instead of, say, coal mining, which there's a lot of work involved, but it doesn't require these highest levels of education and development and specialization. So as companies start to move up the value chain and do more and more value-added work, it's tougher and tougher to figure out what they're really worth, even if they're creating enormous value. And today, with the largest company in the S&P 500 being a technology company that produces highly proprietary products, but is also notoriously non-transparent around employee compensation, precisely because they don't want to lose those quality people to their competitors, it makes the analyst job very difficult indeed.
Yeah. Okay. Probably the last question. Is there any news or evidence, academic evidence, on what ESG information can contribute to markets other than the equity market?
Yeah, certainly the cost of capital studies have revolutionized the thinking on this. For a long time, I think my belief was that the fixed income markets were just factor driven, and because they were large and liquid, it really wouldn't matter if you applied an ESG filter or a corporate social responsibility filter. But now we've seen studies that show bank loans have a lower interest rate for superior social performers. Bond yields are lower for superior social performers. There is a host of indicators that suggest better social performers are getting a better deal from the fixed income markets. And I personally believe those markets are a little easier to study because bond returns aren't as noisy as stock returns. You don't have to do quite as much work to filter what's going on. So to see clear effects there for me was really startling. Yeah.
Yeah, I also, some of my own research also suggested that if you look at, for example, the socially responsible investors in the bond market, as measured by how mutual fund managers in that domain perform. What we learned from that type of research is that most of these socially responsible bond fund managers at least did not underperform their conventional peers. And we actually also highlighted that future research needs to focus on markets other than the US to really highlight more on what the value of environmental, social, and governance information can be for bond investors. I also know that there is quite some attention for ESG in the context of strategic asset allocation. So using that type of information to make choices about how much to allocate to particular asset classes. What I can say there is that not much research has been done on that for sure. It's also not really clear to me how you can easily implement such allocation decisions in a model that takes into account such ESG considerations. I know that some companies are trying to understand the overall sensitivity of asset classes to environmental risks or environmental developments or changes in prices of certain types of energy. Of course, that's the way to go. But what the optimal way is, I think that has yet to be understood.
Yeah, I think it's sensible though. If you think about where are ESG benefits likely to materialize, they're more likely to materialize for a buy and hold long-term investor. If you're renting the stock, maybe you don't care about ESG because the bad things that are going to happen, if they do happen, will happen later over a multi-year time frame. So an investor that is investing across multiple asset classes over the long term probably is going to be sensible in thinking about how would ESG factors impact my returns.
Okay, well, thank you for your attention. Also, thanks to the audience. I think this kind of wraps up today's session. Of course, also, please do not hesitate to send out any questions after this webinar. You know where to find the website, www.fsinsight.org. So, yeah, thank you for your attention.
Thanks a lot.